My name's Ryan Diamisi. I work at Christian Wealth Management as a wealth advisor. My goal is to help my clients redeem their money as a tool to build their faith. So this is Elijah, a friend, and he also is a enrolled agent. Tell us a little bit about that.
Yeah. So an enrolled agent is basically somebody who can prepare taxes and represent individuals and businesses before the IRS within all 50 states. It's like a CPA light usually. CPAs tend to have a much broader knowledge in matters outside of tax. They might prepare corporate accounting, financial statements, auditing, various things like that. But an enrolled agent specializes specifically in tax matters.
Yeah. And you do a good job. He works for families that I know some of them, and yeah, does a great job. So Elijah and I were chatting not long ago about owning a home, and we started a little debate on whether we would do a 15-year or 30-year. So I thought that if we could record the conversation, because for me, I have families I work for that I have not been able to convince to do a 15-year mortgage, and I have no idea why. I feel like I make good cases, but I figured with Elijah here, maybe we could try to work out some of the kinks in my argument. But so I think the first question I want to ask, I know the first question was just, do you want to own a home?
Absolutely.
Okay. And also, let's get some context. So are you married?
Yes, I am married.
Okay.
I've been married for 5.5 years, have one child who is 1.5 years, and another on the way we just found out.
And then do you guys currently own? Are you renting?
So we do not own a home. So I guess that's one main difference between like our positions, right?
Sure. Yep.
But we do want to own a home.
Mm-hmm.
And we would like to own a home, Lord willing, within a couple years.
Okay.
Or at least be in that position.
Yeah. That's the goal. Okay. And then does your wife work?
She works part-time, very part-time, as an ultrasound tech.
Mm-hmm. So you're with your growing family. You guys would like to have a home.
Mm-hmm.
So how do you and your wife, how are you preparing for owning a home?
Yeah, that's a great question, Ryan. We made a very interesting decision early on in our marriage. I think we decided that we wanted my wife to stay in a home when we had children. And I mean, even though she helps and works at this pregnancy clinic, most of the time, 5 days a week, she's at home, helping support and raise our child, feed him, giving him a lot of just love and attention and, Lord willing, education as he gets older, and training up in the Lord, and lots of things that only a mother and a home education can provide. But with that, we decided that we essentially want to be a single income family. And so for the first couple years of our marriage, we lived in Southern California, and we used that opportunity to both work and try to save some money. We only more recently moved to Idaho, and we're not quite in the position to buy a home yet, but we are trying to get there. Now, of course, then the big question is how do you save for a home on a single income, I suppose. And that's, what we're trying to prepare for, and I'm sure maybe you have some questions about that.
Oh, sure. So I guess I'm thinking, okay, the goals, you guys would like to have a home. You're trying to prepare for it. It sounds like you'd saved when you guys were in Southern California because you guys were both working. And you're kind of wanting to be in a position that you can't save again. Yeah. Because you did just make a career shift where you were working with a partner and then started doing it yourself.
Mm-hmm.
So maybe I'm thinking it may not be the most important goal right now is buying a home. Maybe the most important goal is just making sure your cash flow is good and you're with starting this business that you are.
And that's a very important caveat for me in my situation is I recently went out on my own to start this tax preparation business after a couple years of doing it with a partner or working at an accounting firm in the past. Kind of doing it on my own. I feel like there's a lot more opportunity there, but there's a lot more risk involved if you are the business owner. But I believe, and we believe that owning a business is a great way to prepare ourselves and be in that position to earn an income quicker so that we can afford a home in the future, or at least a down payment to get the home.
Yeah. And probably with a business, I would, earning income quickly, having your own business could happen, but it's probably more of the way that I see business is the opportunity long term. There's no upside limit.
Absolutely.
But in the short term, you take some sacrifices for sure because you're having to get business. And so I guess this is a great time because you guys haven't bought a home yet. You're not on Zillow trying to, well, maybe you're on Zillow. Do you use Zillow?
I do. Okay. It doesn't help with my covetousness.
Yeah, it doesn't help with mine either, but I don't have it on my phone, and then I'll go somewhere and see a house for sale, or I'll go somewhere and I like the area and think, how much does a house cost?
So funny. Yeah. We go on walks around town. And we're like, how much is that home for sale? Like, oh, I can't afford that. But maybe one day.
Yeah. Yeah. So it's good to have like things to strive for, but then at the same time, it's, your thought life matters. So if you're spending too much time thinking about stuff that's not for you right now, that could be dangerous. So I guess since we're ahead of you buying a home, which is the best place to be in, I know you're familiar with Dave Ramsey. I know you've prepared some numbers for debate, but what do you think about borrowing money for a home? Is there any boundaries you would have around borrowing money?
I think there should be certain guidelines. You don't want to take off more debt than you can reasonably afford. And I guess the factor of what you can reasonably afford depends on person to person, or depends on what Dave Ramsey or Ramsey Solutions, determines as how much can you afford. I know Dave Ramsey suggests not paying more than 25% of your take-home income. But I think part of the problem is if you ask most people nowadays, they're probably between 30 to maybe 45% of their take-home income is just on their housing costs, whether that's rent or their mortgage or upkeep or taxes. That can be pretty expensive. And that definitely, if you are taking out more than you can reasonably afford, or if you are working in a sector or in a business where your income isn't steady, that can be much more risky than if you have, let's say, a regular W-2 type job where you receive pretty regular wages and you know what your expected income will be each month and each year.
Yeah, there's definitely, depending on your job, there will be variations if you're self-employed versus your W-2. I am curious with just for you and your wife, how do you guys process how much debt you're willing to take on, or how you would view going into a mortgage?
Yeah, that's a very interesting question that you're asking, because generally we don't want to incur any debt. We've taken on a vehicle loan in the last 4 years. When the interest rate we got 1.9% at the time, and we figured, oh, well, we can pay off this vehicle when the interest is so low. I can use this money to
Put it somewhere
invest
else.
it. Yeah,
Sure.
exactly. And make more ROI on that than the cost of the loan over the 4-year duration that we made that. So that was a calculated
Yeah.
judgment that we had made. But generally, we use a credit card for most of our purchases. I like kind of going digital and not having too much cash on hand, but we always have a pretty good tap of about our monthly spending. So we try not to ever get in debt. We pay off our credit card every month. We pay off all of our expenses.
Do you still have the car loan?
I do not.
Okay, because I remember you saying so. Okay, what made you pay it off, or it's just the loan matured?
Yeah, the loan for that car matured in August of last year, so
Okay.
that'd be about 6 months
But then
ago.
you did just buy a relatively nice car, and didn't you pay cash for it?
We did buy a new car, but the reason for that was because my wife, who was driving at the time, was in an accident. And that car got totaled. Insurance, we had an insurance policy that gave us the value of the car plus an additional 20%. So we made the decision to take that money plus a little bit that we had saved
Yep.
and purchase another nicer, bigger,
Yeah.
safer vehicle for her and my child and now children.
And I think the point I'm trying to make within that is you don't have debt anymore.
Correct. Yeah. Currently, we have no debt, and we
Yeah.
generally want to stay out of debt. Now, then I guess the interest or the thought of a mortgage then is a total flip in the opposite direction. Is okay, if we want to purchase a home, then we're going to take on a whole lot of debt,
Yeah.
potentially for the next 15 or 30 years.
Yep. Yeah, I remember when we sat. So I was sitting, you were standing, and I was like, I don't know what I said. Something like, Elisha, do you remember what I said?
What do you think about a 13 or like a 15 versus a 30-year loan?
Yeah. Do you remember what you said back to me?
I just thought I came in a little heated. I thought that it's kind of outrageous at the time to expect the average person to be able to afford a 15-year loan. Dave Ramsey had made a post not too long ago about why doesn't everybody just get a 15-year loan? Well, the problem is that 15-year loans have a sizable monthly increase in the payment that you're making that makes your bottom line for the average American much thinner.
Yep.
And so, I think maybe maybe you can kind of share some of your experiences in dealing with your clients, why having encouraging them to get a 15-year loan versus a 30-year loan or mortgage makes sense. I believe that there are pluses and minuses to each of them, and you have to kind of, it helps to be in the know of what the pros and cons are, and then making the best guess of what you and your family can afford and what makes sense for you.
Yeah, so I want to give you some input for sure, because I want to convince everybody that everything I believe is right, because I'm very proud. But I think the point of really, while I do believe I'm a proud person, I think the point of me doing all of this is that I'm seeing, after doing this 13 years, I'm seeing the same pitfalls that everyone's falling into, and sometimes the same person multiple times over 13 years. And I'm just like, how are we still doing this? So, and obviously it's like I need to learn how to communicate more effectively, because whatever I'm doing is not, my part to play in this doesn't seem like is helpful to the people that I work for. Yeah. So I chose to do a 15-year in 2019 when I bought a home. The decisions I had to make as a small business owner at the time that made okay money was I had to buy a very cheap home that no one wanted. So literally the home we went to, that was not prepared to sell at all. People came to visit the home and I was told like they left very uninterested in the home. So it's just the way that the house was set up to sell was not attractive. But when I walked in there, I could see the potential. I was like, oh, well, first off, I liked the price. The price was good. And then I saw the potential of what some white paint could do on all the walls.
Yeah.
So
I've been to your house more recently, and it looks great. So I'm very curious what it looked like in 2019.
Yeah. And the pictures weren't terrible of it, but it's a small home. That's the other thing. It's just a smaller home. So the more stuff you have in there, the worse it's going to feel. So another thing we did was just get rid of a bunch of stuff that was in the house. But here's the point. So I think one of the sacrifices that people need to make, or the paradigms that needs to get shifted, is the willingness, not even the willingness, to see the opportunity, to embrace it with joy, to own something that's smaller, that they can afford more easily. So instead of like, I know you prepared numbers for if you borrowed $400,000, what somebody would need to make in order to make a $400,000 house work. It's like, what about a townhome or like just something smaller? And the reason being, if it's smaller and there's less pressure on your cash flow, then what that gives you is it protects margin, which is what are your baseline expenses that you need each month, and what's your income? Margin's just the difference.
Yeah.
Because that margin is what helps you see progress on the goals that you have. So if you suck up all of your expenses to meet your income, then it's going to be tough for anybody to see progress on stuff they care about. So in my opinion, the principle is to protect your margin at all costs. So if that means living in something you're renting for longer so you can keep, again, your fixed expenses lower, so you can save, you have more margin, so you can save for a bigger down payment, so you can get the bigger home, great. If it means you get a smaller home, great. But I think, again, like I said, the principle is we want to protect margin. So what do you think about that? How important is margin in your life?
Yeah, I mean, margin is incredibly important in the fact that, like, if all of your expenses are just just to meet your month-to-month, basic daily needs for you and, maybe your family, like, if you're using 90 to 100% of your income just for that, you aren't prepared for an emergency. Let's say something happens, health accident, or if you or your spouse maybe loses their job. Lots of things happen in life, and if you don't have any buffer or any cushion, you put yourself in a very tough situation when ultimately, like, life circumstances happen, and if you aren't prepared, if you have no margin, you can't really be prepared for that. And I know that's one thing that Dave Ramsey advocates for, is having an emergency fund, maybe at least $1,000 or a couple thousand. And then, building from there, you want to have maybe a 3 to 6 month, cushion or blanket. And you can't really build that if you're spending all your money on just your daily cost of living expenses. And if you purchase a larger home and you're spending, let's say, 40 or 50% of your income just on the home itself, you put yourself in a little bit of a tougher situation. When certain things happen, you have no safety net to catch, yourself or float you until you can get into a better situation.
Yeah, it's kind of like with your time. Which I do this a lot, if I book up my entire day with things and then anything comes up, it's going to just frustrate me because I'm already crammed as much as possible into a day. So that principle translates to finances. I have already claimed every dollar to a bill that needs to be paid versus saying, hey, I'm going to budget in a break or opportunity to do something that I didn't plan for. with your finances. I think Dave Ramsey calls that like the miscellaneous part in your budget, to give some breathing room to let the month be the month, which no month goes as planned. So, okay, so we're thinking through the average person when they're thinking about buying a home. They're going to think, they're going to hear I feel like the mainstream media, whatever that means, most like walking around, like advice towards people is to get a 30-year mortgage because the interest is going to be low, and you want you want a lower payment. So that way you can have more margin, whatever. That might be the case for it.
Yeah.
But I'm making a case that the 15 years is the way to do it. And the reason being, you'll have to get a smaller home because the principle of you do want a lower payment is true. You do want margin. But the way to do is getting a 15-year, getting a smaller home. And why a 15-year matters too is as you make a payment on 15 years, the first 5 years, you actually make progress on the principal going down. Unlike a 30-year, if you look at how much of the payment's going towards interest on a 30-year month to month, it's not encouraging in a 30-year versus...
That's a very good point.
So...
do you know about, let's say, in your first 5 years of a 15-year loan, how much of the principal, maybe percentage-wise, would you have paid off at that point? I know it's going to be slim to nil on the 30 because it starts off very slow and then it curveballs up.
Well, 5 years at 5 years over 30, I don't know the percentage, but that's a smaller percentage than 5 years over 15. Like one reason to just think about is 5 years over 15 is 33% of the way there. So even if the amortization schedule was still not in your benefit, you're still a third of the way there after 5 years. Where with a 30-year, you're a sixth of the way there. And that does have an impact on your desire to keep going. But I remember looking at the general numbers, and percentage-wise, it's 30%. When you start a 15-year, about 30% over that is going towards your principal, which 30% doesn't even sound like that much. So just imagine how much worse a 30-year mortgage is. It's a lot less than 30% to start. And the bank's doing great. I mean, you've been in a bank building. They're pretty nice. So they know what they're doing.
Well, they math it out. They always know how to come out on top.
I had a friend refer to it yesterday as, it's kind of like gambling. The house always wins. They know what they're doing. So... have you
heard about 40 or 50-year loans being introduced?
Yeah, I remember that rumor being spread. So, I think... I don't know enough about it, but I don't think it's making progress. I think that it's benefit it's on the table, but I don't think it's going to move forward. And the math just looks terrible for a 40. If it looks terrible on a 30-year, it looks worse on a 40 and 50. So
terrible for you and I, not the banks, right?
The banks probably would do fine, but people would be in a depression. Anyways, so I'm trying to think through again. My goal is to help people think about how, because again, if you're in a 15-year and most people will be in a home they own for 5 years. So if you're in a 15-year mortgage, you've made it 5 years through that mortgage. Just from a motivation standpoint, you're a third of the way there. I think that has to do something to your psyche about just wanting to finish out the loan. You're seeing the value that you owe actually go down after 5 years. With a 30-year, the progress is a lot less substantial. So you haven't read Essentialism?
No, I haven't. No. Not yet.
No, okay.
Maybe you can convince me.
It's it's a book about kind of simplifying your life. I would say that, just majoring on what matters and minoring on what doesn't. And so towards the end of the book, he makes a comment about how to motivate other people and that it's been proven you can't. And as somebody that has hired other people, I'm very interested in knowing, how do I motivate other people? So when he said, yeah, it's been proven you can't, but what you can do is you can show other people progress on what they care about. That when you see progress on what you care about, you'll be like, that will provide motivation. And I think why I'm bringing that up is no one at the end of the day wants to be in debt. No one's going to draw up their life and say, I want to be in debt. So if you have a 30-year mortgage, you're not going to be seeing progress on something that underlying you care about.
Yeah.
And then I do think that the motivation piece, like our emotions, do have a strong influence in our financial decisions, whether we admit it or not. So
yeah, I hadn't really thought about the psychological aspect of if you break it down, let's say, into 5-year segments. 5 years, like, okay, that's 5 years to pay off a 15-year mortgage. So if you knock out 5 years, you're like, okay, I can do that again. I can do that one more time. Mm-hmm. Whereas opposed to, if that's 30 years, that's, okay, I did it once, and I got to do it 5 more times. Like, I definitely do see, like, the emotional and psychological, aspect of, okay, like, if you break this down into tangible pieces, like, it's much more palatable to have a 15-year loan and see what you can knock out and the progress you can make in each of those 5-year segments, and how doable that then becomes if you can convince somebody to take that on, take on that higher monthly payment, but also maybe that smaller house, or maybe other ways you and your family choose to cut out some of your expenses and increase your margin.
Yeah. I think another benefit with that, first off, I should say, like, that perspective is encouraging to hear, because I haven't thought about, I guess you just reinforcing it is encouraging. And the second thing is, if you do a 15-year, the payment is going to be larger than a 30-year. Even if you get a smaller home and then you do a 30-year on a smaller home, which people aren't going to choose a smaller home if they're doing a 30-year, but let's say they did, the payment's smaller versus a 15-year, the payment's going to be larger. The benefit of choosing the 15-year would be you have carved out a larger piece of your budget that when it's paid off, you'll have learned to live without that piece. When it's paid off again, now you can just throw that on to your margin because you've exercised this discipline of not needing that money.
Yeah.
So I think you could cut it so many ways, but at the end of the day, the biggest problem is the enemy wants us to be distracted with our finances, and he wants, in my opinion, the enemy wants us to be distracted. He wants us to tie up all of our income so we're as stressed as frequently as possible. And he's good at, he doesn't really have to work that hard. It feels like in the U.S. where, we've justified it by saying we can invest the difference. Well, I'll just get a 30-year and I'll invest the difference in the market, and the market does better return-wise than a mortgage. And that's true if we're robots and have no emotions, but we're fueled by our emotions. Our emotions cause us to make decisions. So we're not robots. Thank God we're not robots. So I'm curious. Well, I guess the thing is, I don't think this conversation is going to convince you to do a 15-year versus a 30-year, but hopefully you can have some things to think about with Rebecca. That's my hope, is that you're able to think through it more strategically with Rebecca when you guys do buy a home. And my hope is too that as you're building the business that you're in, that you're able to stay in a position that you're not depending on getting more clients, but it's just more you can add because you have the time to do it and you're not making previous commitments.
So let's say, you are in my position, or maybe a similar position. You are maybe a couple years out of college, you have a job, maybe, you're single, you're married, maybe your spouse has a job. maybe I can go through some of my personal reservations
Yeah,
of a 15 versus a 30-year loan.
that'd be good.
And maybe you can maybe help give me some of your perspective as a financial advisor of either walk me through that or maybe, show me some ideas that maybe I don't have fully thought out, because you handle a lot of people's money, yourself, and give, advice to people.
Sure.
And the thought of purchasing a home is one of the biggest financial decisions
Yep.
you could make in your lifetime.
Yep.
Whether or not to buy, and then the duration of how long you want to be paying off, the cost of that home.
Yep.
So, as you were saying, I did write down some notes. And this is just kind of me spitballing for the average American, maybe somebody in and around our positions who has not owned a home yet but is working. I did some research that last year the average American wage or salary was about $62,000 a year. And that the average household income was about $80,000 to $85,000 a year for 2025. So that means that in the average household, there's usually either one person to 1.5, maybe full-time salaries making up that combined household income in the U.S. Now, the average home price last year was about $420,000. Let's say that the home that you want to purchase is $400,000 for simplicity and math's sake for some of these examples, right? Let's say you put down and you work for a little bit, you gather 20% down.
Okay.
So that way you don't have any mortgage insurance or any other unnecessary costs. Let's say you're trying to be prudent and wise and save, and you do that. You get 20% of that, which is $80,000. You put that, you purchase your home. Then you're faced with the question, do I do a 15-year mortgage or a 30-year mortgage? And so for that then $320,000 loan that you're about to take on, you can break that down into monthly payments over 15 years or monthly payments over 30 years. And in this example, the average monthly cost of this loan over 15 years is going to be $2,700 a month. And the average cost monthly for a 30-year loan is about $2,000 a month. So between each of these examples, it's only a $700 difference. But $700 to the average American that's a sizable amount. For most people, that's larger than your average car payment. So maybe if you don't own a car, maybe that's one way. Or if you're not paying a separate loan, that's one definite way that you could kind of work out a 15-year loan versus a 30-year loan. But another aspect of that is then this margin question. And what Ramsey Solutions advises is about not to use more than 25% of your take-home income towards the cost of your home, which is not just the mortgage payment, it's also upkeep, and it's also property taxes. And depending on where you live, that can fluctuate a bit, or year to year, depending on what happens around your house. Your upkeep costs can be a bit different. But the only thing I can kind of factor this out for sure is the cost of the loan. And so the cost then of this loan for 15 years at $2,700 a month is going to be about $32,000 a year. And then the annual costs of a 30-year mortgage is going to be about $2,000 a month, or $24,000 a year, which is probably $8,000, I think, if my math is right.
Difference.
Yeah. Difference a year. And if you spend that amount, as that's your 25% that you are allocating margin-wise for cost of living, if your income is, or if your mortgage cost is $24,000 a year, 25%, you reverse that, you multiply that by 4, that means your take-home pay should be about $96,000 a year. Or if you get the 30-year mortgage, or sorry, the 15-year mortgage, your take-home pay, if you take $32,000, multiply it by 4 for your 25%, should be roughly $130,000 a year. Which then, for the average American, is, even at that point, if we take their average wages, we see that there's a large disconnect.
Because you said the average wage for a household is $80,000, and then based off of the numbers, if you're following Dave Ramsey, it needs to be between 90 if you're doing a 30, which Dave Ramsey would say don't do that. So you need to make 100. If Dave Ramsey was here giving his principles, he would say you need to make 130 take home to buy the average home.
Yeah.
If you have 20% down. Yeah, that makes sense.
Yeah. So that's just from a math perspective, breaking down. I'm not amazing at math myself, but Excel does great things and it can do the math for me. But that's kind of like, if I'm just thinking of rough numbers and, how me and my family approach purchasing a home and then paying off a mortgage, the question is like, how do I get in a place where, I would love that my total housing cost is only 25% of our take-home income. But our family's take-home income has never been enough to approach that 25% margin.
So I don't know if is there a question here, because I have so many thoughts.
Sorry, that was a fire hose. But you mentioned a lot of pitfalls with you and your clients, and I'm sure you've advised them about this 15-year loan. My main question is, how do, let's say, me and my family, or the average American, what would you say to them of how they can approach or try to get in a comfortable state where they can afford a 15-year mortgage?
So, there's every person so different that I come across. Like, the situation will be most of the time, it's like a lifetime. They're already choosing to buy a home, and I just got to milk the opportunity that I have to try to, because they're already convinced they're going to buy a home. So all I've got is they've decided which home, they're working on the loan. It's please get a 15-year, or they're deciding to refinance. It's like my plea to them is please get a 15-year. And they're, I'll get, arguments back where it's like, I'm going to make the extra payments. I'm going to do the, pay by monthly, so that way it pays it off 7 years. But again, it's just you're relying on your memory to do it, and there's too many variables that I'm not convinced that people follow through with it. So my encouragement to people when they're already trying to buy a home is just get the 15-year and sacrifice, if most of the time they've got a car loan or they've got something else that they can get rid of that will make up that difference. So I see the opportunity, like we could just do an exchange on something else that's not helping them either. But for somebody that I do have clients that haven't bought a home yet and are making good money and are able to save for it, I'm just asking them to be patient and save and wait till it's time. Be praying. I got actually this encouragement from a client over the last week, and he said, they do this for cars. They invest money for a car every month. And they say when they want a car, they start praying for it. And they believe God's going to give it to them, and they're not in a rush. And they said every time God has given them what they wanted. And but the variable is when. And that's what in America we don't want to hear, is when. We want now.
That's
so
true. Yeah.
it's like I love that principle because it can carry over to other things. It's like if you know what you want, it may just, that could be a God-given, and very likely is a God-given dream. And it's just, the problem is the enemy always says it's now. You know, that's like the angle he takes is, instead of God's timing, it's you can just have it now. Sex is a good example. You could just have it now. God's the one that created it, but you can just have it now. Why not? So anyways, I'm getting distracted, but I think that's the biggest problem, is the timing problem, that I just, I don't know how to fight somebody on, that's not the right word, but just convince people to just slow down in their decisions. Because, and I don't, you know, I don't think Dave Ramsey's going to listen to this, but if he does, like I wasn't doing the math to see if it was a quarter of my take-home pay. I just looked at the house and was like, and I knew it was going to be tight for a couple of years, but it's like, it's a 15-year. My goal was to get a 15-year. And now it's less than a quarter of my take-home pay. So that's great. But at first, it wasn't. And my solution in my head was, I'm willing to rent out. If things get tight, I'll rent out rooms. So it's like, it's just I think people get a gut feeling of when they're making the right sacrifices.
Yeah.
So,
how do you then, I know you can't convince people, but like, if it's a timing difference for people in purchasing a home, you know, let's say you're dealing with the client of like, I found my dream home. But then you're like, okay, you know, I want to plead and encourage you to try to get a 15-year loan. Do you have reservations, or like how do you express your concern with either the 30-year loan, or maybe just even their ability to afford the home in general? Like how do you advise people through some of these situations when they seem very set on something?
Yeah. I mean, I just give them my perspective. So like if somebody told me, hey, I found my dream home, and the only way they were convinced they could afford it was a 30-year, is I would just tell them, hey, from my experience, the most valuable thing with cash flow and even the assets that I own is, am I able, if I buy something, do I still have margin? Because margin is, again, like if God asked me to do something this month, I'm able to do it because I budgeted for the margin. So if they're not able to do a 15-year, I would say, I don't think you can afford it. Like for me, I'm trying to protect margin, and that's the decisions that I make. And I think ultimately it's not going to be beneficial to whatever you're trying to get out of life. I'm trying to ask people what their vision in life is more, and try to draw it back to like, what do you want to get out of life? Because if you have an overarching goal you're trying to get, sometimes, you know, Proverbs 29 says, without prophetic vision, people cast off restraint. So it's like, okay, using that verse, maybe part of it is for all of us to know, what's the vision God's instilled for you and Rebecca? What's the vision God's given to Rachel and I? And then all of our decisions should submit to, because again, without prophetic vision, people cast off restraint. And that's, look at the households in the U.S. and can look at the White House and the debt that they're in. You could look at the average debt for a family and say, okay, we've cast off restraint for sure. So I think that's my best bet right now, is using the vision. And I should be asking God for wisdom on what to say in those moments. And sometimes I do, sometimes I don't. But I'm trying to lead by example. I'm trying to point to biblical truths. And just for me to say the same message over and over again, because consistent or effective communication is consistent and repetitive. So
it really sounds like you're trying to encourage people to make prudent decisions financial decisions that align with their life vision.
Yeah.
Like make a decision that aligns with your long-term goals and your long-term vision.
Mm-hmm.
And so for most people, when they decide to go ahead with that bigger purchase, or maybe go, against maybe what you believe is proper and sound advice for them and their financial situation, we're making decisions that don't align with our goals.
Yeah. Yeah. I think that's my motivation should be, I should know what my clients want to get out of life. And I should be able to remind them of that. Again, that's like you're motivated when you see progress in what you care about. So I need to remember in those moments to be able to point to, well, what do my clients say they care about? And is this decision going to help them accomplish that? Or is it going to keep them from accomplishing what they care about? And oftentimes it's like simple stuff. Like I talked to somebody yesterday and they want to help their kids put their grandkids into private Christian school. It's like, so they need cash flow to do that. It's like, okay. And they want to be a blessing to their grandchildren and their children while they're still alive. It's like, well, and they're in a position that they can do that. But oftentimes it's when you break it down for people, it's like most people just, they really care about their kids, they care about their grandkids, and they want to have as big of an impact in their lives as possible. So what's a recent financial challenge that you and your family have solved?
A big one is in taking or starting this new business within the last year or so is how am I going to provide for my family? And there was a lot of variables with that. I set up for a financial goal in terms of how much revenue I want my business to create in the next year and the year after that. But for this first year, that's kind of what I'm focused on. And it seems this year we're well on our way to hit that revenue goal. And that's involved a lot of work, sometimes late nights.
And you worked on that with Rebecca, on like creating the goal for how much you wanted the business to.
I told her how much I want to make this first year, and then how much I want to do in the year after that.
And she was supportive when
she's been supportive of that. I didn't want to sacrifice time with my family, and that was the main goal of getting my wife on board with that. Is I would let her know there will be some late nights here and there. If you do taxes, you're familiar with tax season, and there's a very busy season, at least for the months of February to April, and I'd let her know about that. But I did not want to cut too much into either the mornings with helping her out and spending time with our child, feeding him breakfast and spending some time together, and the evenings to spending family time together. And I think it's by the Lord's grace that He's allowed me to reach that revenue goal this last year, or at least be on track for it. But also being able to pour in and spend time with and not sacrifice my family in the process of trying to grow my business. And that involved a lot of prayer, a lot of planning. But I'm very thankful to see okay, things are going in the right direction. Yeah. And I don't know how much I personally had to do with it, but the Lord provided lots of new clients, has allowed me to have a relationship with you and Miles too, and all the other people in your office. And it's just been a huge encouragement to my soul is to be around you and all the people here. It's just been a great environment that's made even the work more enjoyable. And I've been very appreciative of that. and I want to continue to work hard and try to trust the Lord that He's going to provide the clients, the money, the resources, so that like our family can get to the goals and the vision that we want to get to in the next couple of years. And that's what we're talking about, buying a home. And, if we can be in a position to afford a 15-year loan, maybe that involves waiting a little bit more. But if we can knock out a home or get a loan and knock that out in half of my working years instead of all of them, that would be pretty cool.
Yeah.
But right now, the Lord has provided for what we need, and I'm thankful for that.
Yeah. That's awesome. So the challenge for you guys that you faced was income. And sounds like you felt like God gave you a idea of how He would provide the first year. And you've communicated that to Rebecca somehow, and then also intentionally tried to not make your life all about work. But you showed up. I've been in the office. You've showed up, and you've done your part. So, yeah, I mean, that's good stuff. I know I'm thinking about the 6 steps of how to become extremely wealthy and love every minute of it. Step 1 is what you're doing.
Oh.
Finding it. Oh, well, I think. Do you love your job?
I love it right now, yeah.
Okay.
It's been great.
Step 1 is find a job you love. And then step 2 is a good one. It's discover generosity. Discover the joy of generosity. So I'm not sure if we'll change the order of the steps, but so far I think those are 2 good things to think about. Think about for me to be reminded that working while I need to do a better job of balancing family and work. Working is something God created us to do, to like help other people and to figure out a way to redeem that part of our life. And then the next step to be with the income we have to focus mostly on generosity, because Jesus says it's better to give than to receive.
Amen.
And I'm just trusting that that's true. So, because I am not giving more than any other aspect of my life, but that's the hope one day. So, thank you guys for watching. We do have a video talking about the 15 to 30-year mortgage and breaking down some of the numbers. I'm still not convinced that you're going to watch it and be convinced to do a 15-year after it, but my hope is it's at least information that is a vote for a 15-year, where it seems like most of you go on the world, it feels like people tell you to get a 30-year. So hopefully you'll be encouraged by that, and we'll see you next time.
Thanks.